Hi, I'm Barbara Friedberg. I'm the owner of Barbara Friedberg PersonalFinance.com and Robo-Advisor Pros, and I'm here to talk to you today about what to do with your investments given that Britain pulled out of the European Union. Commonly known as Brexit, Europe decided in a close vote that it no longer wanted to be a member of the European Union. Because of this decision, stock markets have fallen worldwide, and some investors may be scared. And if you're one of those investors that's scared or confused and you don't know what to do, I'm here to provide a little bit of perspective, because I've been down this road many times before. So we're going to talk a couple of things today. First, we're going to talk a little bit about what this means for your investments and what you should do, if anything, today. So what the markets don't like is uncertainty. And although the vote to exit the European Union was well known, the predictions about what would happen, the result, were quite wrong. In general, the markets believed that Britain would stay in the European Union. And investment markets like certainty. They don't like surprises. And so when the British people spoke and they said, we want to leave the European Union, the financial markets worldwide got spooked. Now, is this an unusual occurrence? Actually, no. It's what's called a systemic risk or a systematic market risk. And what that means is an event that happens in a country or a world that causes investment markets to fall. And it doesn't matter if you've got a great earnings or a wonderful company, but almost all of the stocks in the markets will react. And that's what happened with Brexit. So the question is, what do you do about that? Should you panic? Well, first of all, the answer is no, you should not panic. And let me help you understand why. First of all, stock market investing, something that a place that many of us put our money for the future. We want it to grow. We want our dollars to grow in our 401ks, our retirement accounts, so that when we retire, we'll have more money. And in order to get the higher returns that a stock market provides, well, you have to take a little risk. And that risk is the volatility or the up and down movements of the stock market. Now, today, since markets have closed, June 24th, 2016, the day after the vote for Brexit, the Dow has fallen 600 points. That's a big move. It can be kind of scary for investors. Is it historic? No, the Dow has fallen greater amounts in other times. And what investors need to know is this happens. It's not unusual when you're investing. So if you can understand that over the 200 years that stock markets have been around, there have been many other instances where there have been very big stock market declines. When the dot-com bubble burst at the beginning of 2000, stock markets declined. Just more recently, during 2007 to 2009, the mortgage meltdown, the subprime mortgage crisis, the economic recession, markets fell then too. But what you'll notice, if you look at a chart of the investment returns for stock markets over time, it has always rebounded in the past and gone on to really new heights. Now, does that mean that this is definitely going to happen this time and that it'll happen tomorrow? No, of course not. Nobody knows the future, not even me. And all we've got to go on is really the past. So if we assume that the past will in some way approximate the future, you can be confident that over the long term, your stock market values will rebound and they will continue to go back up. So with that historical lesson in mind, what should you do today? Well, number one is don't look at your investment statement. Don't log online and see how your 401k performed. There's no benefit to that except for making you upset, anxious, nervous, because your investments went down. I guarantee it. So by looking at it, you'll feel lousy. So what do you do for the future? Well, as we said before, if history is any indicator, it's likely over the next several years the stock markets will rebound and they will continue going up. In fact, if you think that the U.S. and global businesses on par in the future are going to grow, well then the stock market is a good place to invest and grow your money, because what you're actually doing is buying into individual companies. So for most of you out there, I'd say don't do anything. Just have confidence that if you're a long-term investor, you don't need your money within the next 5 years, then you would be well put to just continue investing every month or every couple weeks if you're investing in your 401k, or regularly if you're not, and just continuing to invest within the financial markets. What if that's not you? What if you're facing retirement within a year, or worse yet, today or tomorrow? Well, if that's you, consider, first of all, are you taking out all your investment money today? Do you need it all today? Probably not, because it's got to last you many decades while you're in retirement. So again, the advice holds, don't sell today, because what will happen if after a decline you sell your investments, you have locked in those losses. And then you've created another problem for yourself. You don't know when to get back into the investment markets, because ultimately they'll rebound. You just don't know when. And unfortunately, after you know that the stock markets have rebounded and gone back up, you'll have missed a good part of that reversal. So again, back to our initial thoughts. It's the best idea, just stay the course. Keep investing if you are already doing that. If you're not, don't look at your statements. It's very likely that within the next few years, your investments will rebound. They might rebound next week. You don't know. But over the long haul, it's likely that stock market investments will go up. And if you're diversified, if you have some bonds, if you have some cash in mutual funds in your investment portfolio, well then the decline in the stock market will be offset a little bit by your other holdings. And that's one of the benefits of having a diversified portfolio. So for today, the takeaway is don't panic, don't sell, and just be patient. Keep with your plan. And if this is just too much for you and stressing you out too much, then in general, you may want to reassess your asset allocation or your percentage of stock and bond investments and lean a little more to having a little greater percent of your investable assets in bonds. Thanks so much for listening. If you have any questions, any concerns, any worries, please, I am here to guide you in your path to build wealth with investing. Please come visit me at either BarbaraFriedbergPersonalFinance.com or RoboAdvisor Pros. Happy investing and keep cool.